Picture this. It's a Tuesday afternoon, and somewhere in a glass tower in Manhattan, a guy with a Wharton MBA, a $12,000 suit, and a Bloomberg terminal that costs more per month than your rent is staring at 47 screens, trying to figure out where the market is going next. Meanwhile, you opened an app on your phone 3 months ago, tapped a few buttons, and bought something called VTI. And here's the part that should make that guy in the glass tower deeply uncomfortable. You're probably going to end up with more money than him. Not because you're smarter, not because you got lucky, but because you accidentally stumbled into the single most counterintuitive truth in all of personal finance. The less you try to beat the market, the more likely you are to beat the people trying to beat the market. My name is Bob, and I spend way too much time thinking about money, financial psychology, and why the investment strategies that sound the most boring are almost always the ones that actually work. If you've ever wondered why everyone keeps talking about index funds, but nobody really explains why they win, hit that subscribe button and give this video a thumbs up if it ends up changing how you think about investing. Now, before we get into the math, let me ask you something. When you imagine a great investor, what do you picture? Probably someone glued to financial news, someone who knows which sectors are hot, which stocks are about to pop, which earnings reports are going to surprise. Someone active, someone sharp, someone doing something. Here's what nobody tells you. That mental image is costing ordinary people hundreds of thousands of dollars over their lifetimes. And the data on this isn't even close. Let's start with a number that should permanently change how you think about Wall Street. Over any given 15-year period, roughly 90% of actively managed funds underperform a simple index fund tracking the S&P 500. Not 51%, not 60%, 90%. That's not a bad year. That's not a rough patch. That's the long-run track record of an entire industry staffed by some of the most educated, most resourced, most incentivized people on Earth. And 9 out of 10 of them lose to a fund that does absolutely nothing except hold every stock in the index and wait. This data comes from the S&P SPIVA report, which is basically the scoreboard that Wall Street wishes didn't exist. They publish it every year. Every year it says roughly the same thing. And every year, billions of dollars still flow into actively managed funds because the story those funds sell is more emotionally compelling than the reality. So what exactly is an index fund? And why does doing nothing beat doing everything? An index fund is almost embarrassingly simple. It doesn't try to pick winners. It doesn't have a team of analysts reading earnings transcripts at midnight. It doesn't make bets on oil prices or interest rate movements or which tech company is going to dominate the next decade. It just buys everything. If you own a fund that tracks the S&P 500, you own a tiny slice of 500 of the largest companies in America. Apple, Microsoft, Amazon, Johnson & Johnson, Berkshire Hathaway, all of it, proportionally weighted by market size. When one company grows and another shrinks, the index automatically adjusts. No human judgment required. John Bogle, the founder of Vanguard and the person most responsible for making index funds accessible to ordinary people, had a phrase for this. He called it owning the haystack instead of looking for the needle. Everyone else is hunting for the one stock that's going to 10x. You're buying every stock and letting the ones that 10x carry the portfolio, while the ones that collapse barely dent it. And here's what makes this so mathematically ruthless. In any given year, a huge percentage of total market returns comes from a tiny handful of stocks. JP Morgan research found that from 1980 to 2020, roughly 40% of all stocks in the Russell 3000 suffered a catastrophic loss of 70% or more and never recovered. But the index kept climbing because the winners, the Amazons, the Apples, the Microsofts, more than compensated for the losers. If you're trying to pick stocks and you miss those handful of massive winners, which you almost certainly will, you lose. If you own the whole index, you can't miss them. They're already in there. But here's where most people push back. They say, okay, sure, average fund managers underperform. But what about the great ones? What about the legends? What about the guys who've been crushing the market for decades? This is where it gets really interesting, and honestly, a little uncomfortable. Let's talk about something called survivorship bias. It's the single biggest trick the financial industry plays on your brain without you even noticing. Here's how it works. Imagine a fund company launches 10 funds in the same year. Over the next decade, 7 of them underperform the index and quietly get shut down or merged into other funds. 3 of them outperform. The company then markets those 3 funds aggressively. They're highlighted in brochures. They get feature articles in financial magazines. Their managers go on CNBC. What you never see is the 7 funds that quietly disappeared. They're not in the performance data anymore because they don't exist. So when you look at the average returns of active funds, you're already looking at a survivor-selected sample. The losers got deleted from the scoreboard before you arrived. Research from Vanguard found that roughly 40% of active funds are liquidated or merged every decade. That's not a footnote. That's almost half the competition disappearing before the race is officially scored. So when someone points at a fund manager with a great 10-year track record, the question you need to ask isn't how good is this person. It's how many people just like this person tried the same thing and failed and vanished before you ever heard about them. And then there's the other problem. The ones who do outperform for a stretch. Can they keep doing it? The answer, almost uniformly, is no. Standard & Poor's tracks something called performance persistence. The question is simple. If a fund beats the market this year, is it more likely to beat the market next year? The answer is almost perfectly random. Top-performing funds in one 5-year period show no statistically meaningful tendency to outperform in the next 5-year period. The hot hand doesn't exist. Or more precisely, it exists just often enough to make people believe in it, then disappears just often enough to destroy them financially. Now, here's the part that makes the whole thing almost comically unfair for active managers. And this is something Bob thinks about constantly because it completely reframes the whole debate. Even if a fund manager is genuinely skilled, even if they can actually identify undervalued companies better than average, they still have to clear a bar that has nothing to do with skill. Fees. The average actively managed mutual fund charges somewhere between 0.5% and 1.5% per year in expense ratios. Some charge more. Some charge significantly more if you include sales loads and advisor fees layered on top. A typical S&P 500 index fund, something like Vanguard's VOO or Fidelity's FXAIX, charges somewhere between 0.03% and 0.04% per year. Let's run that math slowly, because the difference is almost offensive once you see it clearly. Say you invest $50,000. Both options return 8% gross before fees. The index fund, at 0.04%, costs you about $20 per year. The active fund, at 1%, costs you $500 per year. Over 30 years, that 0.96% annual difference compounds into roughly $140,000 in lost wealth on a $50,000 initial investment. That's not counting additional contributions. That's just the fee drag silently working against you every single year. Warren Buffett, who has a fairly strong opinion on most things financial, put it this way in his 2016 shareholder letter. He estimated that the investment management industry has extracted something in the range of $100 billion per year from American investors over the past decade, through fees that mostly weren't justified by performance. The money didn't go to zero. It transferred from your account to theirs. And here's the cruel part. Because fees compound in reverse, meaning they compound against you rather than for you, the higher the fee, the bigger the hole the fund manager has to climb out of before they even start beating you. A fund charging 1% annually doesn't just need to be a little better than the index. They need to be consistently, significantly better just to break even with a low-cost index fund after fees. And as we already established, 9 out of 10 of them can't do it. There's another layer to this that goes beyond fees and survivorship bias, and it might be the most underappreciated reason index funds win. It's called market efficiency, and it sounds like an economics textbook concept, but it has extremely practical implications for your money. Here's the basic idea. In liquid public markets with millions of participants all analyzing the same information, Asset prices tend to reflect everything that's knowable about a company pretty quickly. Not perfectly, not instantly, but well enough that finding genuinely mispriced stocks consistently is extraordinarily difficult. Think about what happens when a company reports strong earnings. Within milliseconds, trading algorithms are repricing the stock. Within minutes, professional analysts are updating their models. Within hours, the financial news cycle has processed the information and the market has largely incorporated it. For you, sitting at home trying to decide whether to buy that stock based on the earnings report you just read, the information has already been priced in before you even finished the headline. This doesn't mean markets are perfect. They're not. Bubbles happen, panics happen, mispricings exist. But exploiting those mispricings consistently before the rest of the market corrects them, before fees eat your alpha, before taxes on frequent trading take their cut, is genuinely, brutally difficult. Eugene Fama, who won the Nobel Prize in Economics partly for his work on this, summarized it in a way that's stuck with Bob ever since. The expected return on active management is below average by definition because the average active investor's gross return equals the market return, and their net return is lower after costs. Not some active investors, the average active investor. The math is structural. It's not a matter of trying harder. But okay, let's steelman the other side for a second, because it deserves an honest look. There are genuine arguments for active management in certain situations. In less efficient markets, small cap stocks, emerging markets, certain bond sectors, there's more room for skilled analysis to find mispricings because fewer professionals are looking at those assets. Some evidence supports this. In a severe downturn, an active manager might reduce equity exposure and cushion losses in ways a pure index fund can't. Your index fund will ride the market down 35% without blinking. And there are a small number of managers who have demonstrated genuine fee-adjusted long-run outperformance. They exist. They're just extremely rare, nearly impossible to identify in advance, and their best funds are often closed to new investors by the time the track record is long enough to be convincing. The honest version of this debate isn't that active management never works. It's that the odds of you picking the right active manager in the right fund at the right time and holding it long enough for the outperformance to materialize while paying fees that don't erode the advantage are extremely low. Low enough that for most people, most of the time, the index fund is the statistically dominant choice. Here's something that might surprise you about who actually figured this out first. It wasn't retail investors. It wasn't financial journalists. It was the institutions. Pension funds, sovereign wealth funds, university endowments. The organizations managing the largest pools of money on Earth have been steadily shifting toward index-based investing for decades. The Yale Endowment, famous for its sophisticated alternative investment strategy, still uses massive amounts of passive indexing as its core foundation. And perhaps most tellingly, Warren Buffett, the single most celebrated stock picker in human history, has explicitly instructed the trustee of his estate to put 90% of his wife's inheritance into a low-cost S&P 500 index fund after he's gone. Read that again. The greatest active investor alive looked at what happens to money managed by people who aren't him, and his answer was index fund. If that doesn't tell you something about the baseline strategy for ordinary investors, nothing will. Now, let's get practical, because understanding why index funds win is only useful if you actually know how to use them. The first thing to understand is that not all index funds are created equal, even though the concept is simple. Expense ratio is your first filter. For broad market US funds, there's no reason to pay more than 0.10% per year. Vanguard, Fidelity, and Schwab all offer funds below that threshold. Fidelity even has a couple at 0%. The difference between 0.03% and 0.50% might sound tiny, but as we already showed, it's not. The second thing is understanding what you're actually indexing. An S&P 500 fund gives you large cap US companies. A total market fund adds mid and small cap exposure. An international index fund adds global diversification. None of these are wrong answers, but they're different bets. Most financial educators suggest some combination of US total market and international as a starting point. but the specific split matters less than actually having both. Third, and this is where a lot of people trip up, tax efficiency. Index funds are naturally more tax efficient than active funds because they trade far less frequently. Every time an active fund sells a winning position, it potentially generates a taxable capital gain that gets passed to you. Index funds turn over their holdings rarely, which means fewer taxable events. In a taxable brokerage account, this difference adds up meaningfully over decades. Fourth, resist the urge to tinker. This sounds simple, it is not simple. Because every time the market drops 20%, your brain is going to generate extremely compelling reasons why this time is different, why you should move to cash, why you should wait for things to stabilize before buying back in. This is where most people destroy the advantage that index funds hand them. The returns are there in the long-run data, but those returns include every crash and every recovery. If you sell during the crash and miss the recovery, you don't get the long-run number, you get the crash. JP Morgan calculated that if you were fully invested in the S&P 500 for the 20 years ending in 2022 and did absolutely nothing, you'd have averaged about 9.8% annually. But if you missed just the 10 best trading days during that period, your return dropped to 5.6%. Miss the 20 best days, and you're at 2%. Most of those best days happen during and immediately after crashes, when every instinct in your body is telling you to get out. The strategy only works if you stay in it. Here's the mindset reframe that ties all of this together, and it's one Bob thinks is genuinely underappreciated. Choosing an index fund isn't settling for average. That framing is exactly backwards. When 90% of professionals underperform the index over long periods, matching the index means beating 90% of professionals. You're not accepting mediocrity. You're selecting the outcome that the data says most skilled, well-resourced, full-time investors can't achieve. The average feels like losing because we're trained to believe that more effort, more expertise, more activity produces better outcomes. In most areas of life, that's true. In investing, in public liquid markets, it frequently isn't. The effort paradox is real. The more aggressively you try to beat the market, the more fees you generate, the more taxes you trigger, the more behavioral mistakes you make during volatility, and the further behind you fall. The boring choice is the high-performance choice. And once you internalize that, something genuinely liberating happens. You stop watching CNBC for stock tips. You stop agonizing over individual earnings reports. You stop second-guessing your portfolio every time the market moves 3% in a week. You set it up, contribute consistently, and let compound interest do what it does over 20 or 30 years. And somewhere in a glass tower in Manhattan, a guy with a Wharton MBA and a $12,000 suit is working 80 hours a week trying to beat you. Good luck to him.